global scene for financial markets has changed forever, and it will continue to evolve rapidly. With debt levels now far higher than what precipitated the 2008 GFC, and central banks seemingly wedded to printing money as their only solution, we can expect significant volatility in the coming decade. This makes it extremely challenging for independent investors to build wealth with any degree of confidence. Now, independent investors fall into two categories. The first operate their own self-managed super fund, but largely take their asset allocation advice from financial planners who in turn typically direct their money into managed funds. These managed funds by and large track the performance of the overall stock indices because they're just basically a buy and hold exercise on the major stocks that make up that index. This approach seeks to use diversification to manage risk, but my firm view is that it guarantees underperformance while not really achieving the aim of reducing risk. One only has to look at the decimation of many superannuation funds during the GFC, and that has dramatically changed the retirement plans of many investors. The second category of investor seeks to make their own individual decisions about which stocks to own based on their own research, or perhaps gathering of information from various sources. Now, any investment carries some degree of risk, even so-called risk-free investment government bonds. Just ask investors in the Greek government bonds who've just taken in excess of a 70% capital loss. However, the investing formula below provides the most assured way to build wealth over time at risk levels which are lower than many people knowingly engage in by owning so-called blue chip companies. To know that this is a true statement, just think about blue chips like HIH Insurance, which was Australia's second largest insurer before it collapsed. Babcock & Brown, which was Australia's second largest merchant bank and on par with Macquarie Bank before it completely disappeared. Centro Property Group, which is one of our largest shopping centre owners, supposedly offering a secure income stream through dividends. And then, of course, there was ABC Learning, who just expanded too quickly and became a global player in childcare centres, but eventually completely imploded. These businesses all disappeared, taking investors' money with them, but there's been a lot of underperformers over lengthy periods of time, such as Telstra, which remains at only 36% of its peak 13 years later. And there was Macquarie Bank, which is at 30% of its pre-GFC highs. We saw retailer Billabong recently decline significantly in price, and it's now 85% below its peak price achieved in 2007. Amcor, a major paper and packaging company, is still trading below the highs that it set in 2004 and again in 2002. Then, of course, we've got Boral, which is 50% below its 2006 highs. David Jones in the retailing sector, 60% below the peak it achieved in 2009. We've got one of Australia's major insurers, the Insurance Australia Group, 52% below its peak. We've got National Australia Bank, 45% below its peak price. We've got Qantas, our national carrier, 71% below the peak price. And finally, BlueScope Steel, which is trading at 95% below its high price achieved in 2008. Now, there are numerous others which were regarded as safe blue chip companies that have cost investors very dearly because they left their money in the hands of the managed fund industry thinking that diversification meant low risk. And this has simply been a disaster for many people. We're now in an age where many old practices and supposed truisms must be thrown out and a fresh look taken at effective investing. There is no question that the next decade or more will be one for astute stock picking, having a small number of high quality businesses which are monitored regularly and thoroughly. And as Warren Buffett used to say, have a small number of eggs in your basket and watch that basket very closely. So what are the key questions for investors now? The first one is, what type of investments offer the highest reliability and performance over time, and what are the elements that make them such consistently strong performers? And the second question is, what do you require to stay on track with your strategy over the long term? So to summarise the elements of the best investments, they are companies that produce a high and consistent return on equity, which drives value to shareholders. They produce above average and consistent growth in earnings per share. They will tend to have low or very comfortable debt levels, which can be easily managed even through crisis financial conditions. They have strong growth prospects in their industry sectors, irrespective of the global macro conditions. They require little in the way of additional funding from shareholders to grow, and that's a key point. And they also have management that uses shareholder funds efficiently and treats shareholders well by sharing the wealth with them rather than squandering it on overpriced acquisitions or perhaps outlandish bonus schemes for themselves. There are not many companies that fulfil these criteria in Australia, and certainly at the level that I require, but they are out there. Furthermore, this is a pretty dynamic world we live in, and so continual research is imperative to ensure that current investments continue to meet the stringent criteria. The final elements that are required for independent investors to succeed over the longer term are you require an information source which is constantly appraising the current investment portfolio and market opportunities. Secondly, to know when prices are truly attractive, both from a fundamental point of view and from a technical view. And finally, to have a high level of support that it helps to maintain clear perspective during market highs and lows. It's one thing to have a game plan devised with a cool head, but it can be another thing altogether to be able to make clear and appropriate decisions when market gyrations and the media lead to emotional responses. The bottom line is this: you can become a world-class investor, generating compounding returns that over time can grow to be well above the norm. Warren Buffett became the world's greatest investor not because he knew how to buy stocks cheaply, although he certainly did do that in the early days, but his real secret was investing in safe businesses that could compound their earnings decade after decade. And you can do that too with a little help. If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.